Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Elliott Wave Theory Explained, a practical guide for traders and investors. The rules and guidelines of Elliott Wave Theory. To effectively use Elliott Wave Theory in analyzing markets, it's important to adhere to defined rules and guidelines. These principles not only help identify wave patterns but also ensure your interpretation aligns with the theory's framework. Below, we'll cover the essential rules for impulse waves, the flexibility of corrective waves, and the common patterns you should recognize. 3 key rules for impulse waves. Impulse waves are the backbone of Elliott Wave Theory and follow strict rules. Ignoring or bending these rules can lead to miscalculations and poor trading decisions. Here are the 3 non-negotiable rules. Wave 2 cannot retrace more than 100% of Wave 1. Wave 2 represents a pause in the trend but must not retrace entirely to the starting point of Wave 1. If it does, it invalidates the impulse sequence. For instance, if Wave 1 moves a stock price from $50 to $60, Wave 2 should never drop below $50. Wave 3 cannot be the shortest impulse wave. Wave 3 is generally the strongest and longest wave, driven by growing participation in the trend. While it doesn't have to be the longest wave, it cannot be shorter than both Wave 1 and Wave 5. This rule ensures the trend maintains its momentum. Wave 4 cannot enter the price range of Wave 1. Wave 4 must stay above or below the price range of Wave 1, depending on the trend direction. This separation maintains the distinct structure of the impulse wave. Overlapping these waves can signal a different pattern, such as a diagonal triangle. These rules provide the structural clarity needed to correctly identify a 5-wave impulse. Breaking any of them suggests the pattern you're observing isn't an impulse wave, which could save you from a costly mistake. Guidelines for corrective waves. Corrective waves are more complex than impulse waves because they allow for greater variability. Unlike the well-defined 5-wave impulse structure, corrective waves can form several shapes. However, understanding the typical characteristics of corrections will help you decipher their patterns. Corrective waves consist of 3 subwaves. Most corrections follow a 3-wave structure labeled A, B, and C. Wave A moves against the trend, Wave B creates a minor retracement, and Wave C pushes further in the direction of Wave A. They are often sideways or choppy. While impulse waves are decisive, corrective waves tend to be messy. The market might appear indecisive during these moves, creating back and forth price action. Flexibility in formations. Corrective waves take on varied shapes, including zigzags, flats, and triangles. Knowing these forms helps you anticipate market behavior even when corrections don't fit a perfect pattern. Guided by Fibonacci ratios. Just as with impulse waves, corrective waves often adhere to Fibonacci retracements. For example, Wave C in a corrective move commonly matches or extends 1.618 times the length of Wave A, depending on market strength. Being flexible with corrective wave interpretations is key. While the rules for impulse waves are rigid, corrective wave guidelines allow room for observation and adjustment. Common wave patterns to watch for. Recognizing common wave patterns is an essential skill for anyone using Elliott Wave Theory. These patterns show up frequently in corrective phases and can help you assess where the market might head next. Below are the most common types. Zigzags, 5-3-5. This is the simplest corrective pattern. It consists of 5 waves in Wave A, 3 waves in Wave B, and 5 waves in Wave C. Zigzags typically show steep retracements and signal a continued trend after the correction ends. Flats, 3-3-5. Flats involve 3 waves of roughly equal length for Wave A and Wave B, followed by 5 waves in Wave C. Prices in flats tend to hover within a narrow range, showing balance in buyer-seller pressure before eventually breaking out. Triangles, 5-3-3-3-3. Triangles are consolidating patterns that consist of 5 sideways waves. These waves form a contracting shape, like a wedge, and usually appear in Wave 4 or Wave B positions. Triangles signal hesitation in the market but often precede a sharp breakout in the direction of the overall trend. Understanding these patterns isn't just about memorizing shapes. It's about knowing what they represent: shifts in market sentiment, temporary pauses, or continued momentum. By recognizing these formations, you gain a deeper comprehension of how the market breathes and moves. How Elliott Wave Theory is used in financial markets. Elliott Wave Theory is more than just a concept, it's a tool that helps traders identify trends and possible reversals. By mapping out how markets move in predictable wave patterns, traders can look for opportunities to enter or exit based on the bigger picture. Its principles hold true across different asset classes, whether you're trading stocks, currencies, or cryptocurrencies. Let's look at how this theory is practically applied in these markets. Applying Elliott Wave analysis to stocks. Stock markets are particularly suited for Elliott Wave analysis because they often exhibit clear trends and corrections. Stocks tend to follow predictable human behaviors driven by greed, fear, and market sentiment, which form the backbone of wave patterns. Traders use Elliott Wave theory in stocks to identify the 5-wave pattern of an upward trend and compare it to the 3-wave structure of a correction. For example, impulse waves in stocks often appear during strong bull markets. Wave 3, typically the largest, may coincide with major news, earnings reports, or economic growth. Corrective waves usually show a pullback, but within the larger structure, they can help traders prepare for the next upward move. How does this help traders? If a trader recognizes that a stock is in a corrective wave 2, they can anticipate wave 3, which might represent the strongest upward move. They can then time investments to maximize profits before the wave peaks. For instance, suppose a stock climbs from $50 to $70, wave 1, and dips to $60, wave 2. A trader expects the next wave 3 to push the stock to $90 or more. By analyzing charts and Fibonacci retracement levels, they can confirm this potential trend and plan their entry. Elliott Wave also aids in understanding market psychology. During impulsive waves, optimism dominates, while fear and cautious behaviors dominate corrections. Recognizing these emotions within the patterns helps traders remain calm and confident during volatile moves. Using the theory in Forex trading. The Forex market, known for its liquidity and high volatility, offers ideal conditions for Elliott Wave applications. Currency pairs often display wave-like movements that reflect shifts in economic policy, geopolitical events, and market sentiment. Because Forex traders deal with currency pairs rather than individual assets, Elliott Wave theory plays a pivotal role in spotting potential trend reversals and market continuation patterns. Here's how it's used. Identifying trends. If a trader recognizes the 5-wave structure signaling an uptrend, it can indicate a strong bullish move in a currency pair like EUR/USD. Spotting reversals. A completed impulse wave followed by corrective wave patterns can signal an upcoming market reversal. In practical terms, say the GBP/USD pair is in wave C of a corrective phase, which may retrace a significant portion of the prior uptrend. A trader might wait for wave C to finish before entering, reducing the risk of buying at the wrong time. Fibonacci levels often provide confirmation, with retracements lining up at key levels like 38.2% or 61.8%. Unlike stocks, Forex markets are more influenced by macroeconomic policies, which can cause irregularities in wave patterns. However, when paired with other technical tools, such as moving averages or RSI, Elliott Wave theory becomes even more effective in understanding market movements and timing trades. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.